Money and Markets, Series 3, Lesson 4. What happens when you sell something you don't own? Not a trick question, not a riddle. It's how short selling works. And it's one of the most misunderstood mechanics in all of finance. Most people learn investing as a one-direction game. You buy low, you sell high, and the difference is your profit. But there's a mirror image of that trade, one where you sell first and buy later, where you profit when prices fall instead of rise. Short selling turns the normal logic of investing upside down. And today we're going to walk through exactly how it works, step by step. The borrowing, the selling, the covering, the margin requirements, and the locate rule. A full worked example with real numbers. The financing costs that eat into your profit. And the reason short sellers can lose more money than they ever put in. Let's start with the mirror. When you buy a stock, the logic is simple. Buy low, sell high. You pay $50 for a share, the price rises to $70, you sell. Your profit is $20. Short selling is the mirror image. Sell high, buy low. You sell a share at $70, the price drops to $50, you buy it back. Your profit is still $20. But the order is reversed. Instead of buy first, sell later, it's sell first, buy later. The profit math is the same, selling price minus buying price. But the sequence flips. This raises an obvious question. How can you sell a share you don't own? You can't just walk into the market and sell imaginary stock. You need to get your hands on real shares first. And the way you do that is by borrowing them. Here's the short selling process broken into 5 steps. Step 1, borrow. You find someone who owns the shares, usually through your broker, and you borrow them. The shares leave their account and enter yours, temporarily. Step 2, sell. You immediately sell those borrowed shares on the open market at the current price. Cash from the sale lands in your account. Step 3, wait. You hold the position. Maybe days, maybe weeks, maybe months. You're waiting for the price to drop. Step 4, cover. When you think the price has fallen enough, you buy the same number of shares back on the open market. This is called covering your short position, or buying to cover. Step 5, return. You hand the shares back to the original lender. The loan is closed. If you bought them back for less than you sold them for, the difference is your profit. That's the entire cycle. Borrow, sell, wait, cover, return. 5 steps. Before you can short a single share, 2 requirements must be met. First, the locate. Your broker must confirm that the shares you want to short are actually available to borrow. That is the technical term, locate. Not every stock is easy to borrow. Popular shorts, small companies, thinly traded names. The supply can be limited. If your broker can't locate the shares, you can't short them. Period. Second, the margin. In the United States, you need a margin account approved by your broker. And the rules are strict. Under Regulation T, you must post collateral worth at least 50% of the short position's value. That's the initial margin. Once the trade is open, you must maintain enough equity in the account. Exchange rules require a minimum of 25% maintenance margin. Many brokers set the bar even higher for risky or volatile names. And the cash from the sale? You can't just spend it. Those proceeds stay restricted in the account as part of your collateral. If the stock rises and your equity falls below the threshold, margin call. Either you put up more cash, or the broker closes your position for you. Let's walk through a real example. A hedge fund, let's call them Fund ABC, believes that a company called M&Q is overvalued. The stock trades at $80 a share. Their analysts think the fair value is closer to $60. Fund ABC decides to short 500,000 shares. But there aren't many shares available to borrow, so the stock borrow fee is 5% per year. They execute the short sale at $79.20 per share. Not 80 because they're selling a large block, the execution price slips slightly. 500,000 shares times $79.20 equals $39,600,000. That's the cash they receive from the sale. 6 months later, M&Q has dropped. The stock trades around $72. Fund ABC buys back 500,000 shares at $72.33 per share. That's 500,000 times $72.33, which equals $36,165,000. Gross profit before any costs is $39,600,000 minus $36,165,000. That's $3,435,000. A very good trade. Before we talk about what it costs to borrow, that gross profit doesn't come free. When you borrow shares, you pay a fee. Think of it like interest on a loan, except instead of borrowing money, you're borrowing stock. The borrow fee is usually quoted as an annual rate on the market value at the time of borrowing. In our example, Fund ABC borrowed 500,000 shares when the stock was at $79.20. That is $39,600,000 of borrowed value. The fee is 5% per year. Using compound interest for 6 months, $39,600,000 times the square root of 1.05 minus 1. That works out to roughly $977,000 in financing cost. But there's another cost to consider. If M&Q pays dividends during those 6 months, the short seller must pass those dividends through to the lender. The lender still owns the economic interest in the shares, even though they've been lent out. You owe them whatever income those shares would have generated. So the total cost of a short position is 2 things: the borrow fee plus any dividend or coupon pass-through. Net profit for Fund ABC, $3,435,000 minus roughly $977,000. That is approximately $2,458,000. Still a strong trade, but almost $1 million went to the cost of borrowing. Now here's the part that separates short selling from regular investing. The risk is not symmetric. When you buy a stock for $50, the worst case is that it goes to zero. You lose $50. Your maximum loss equals what you paid. Painful but bounded. When you short a stock at $50, what's the worst case? The stock rises to $100. You've lost $50. It rises to $200. You've lost $150. $500? You've lost $450. $1,000? You're down $950 on a $50 position. There is no ceiling on how high a stock price can go. Prices can rise without limit, which means your losses can grow without limit. Theoretically, the loss from a short position is infinite. This is not an abstract point. It's the single most important thing to understand about short selling. When you're long, you can lose what you invested. When you're short, you can lose more. Much more. Potentially everything. This asymmetry, bounded gains, unbounded losses, is what makes short selling fundamentally different from buying. Given those risks, it's no surprise that regulators sometimes step in. During the 2008 financial crisis, confidence in banks was collapsing. Share prices of major financial institutions were in freefall, and short sellers were piling on. Governments feared a death spiral. Falling prices triggering more fear, triggering more short selling, triggering more falling prices. The response was dramatic. Regulators in the United States, the United Kingdom, and several other countries banned short selling of financial stocks. The logic was simple. Stop the expression of pessimism and maybe you stop the panic. Did it work? The evidence is mixed. Banning short selling didn't delete the pessimism. It just prevented one channel for expressing it. Markets remained volatile. Some studies suggest the bans actually made things worse by reducing liquidity and widening spreads. The debate continues, but the precedent is clear. When authorities believe short selling is accelerating a crisis, they have the power and sometimes the will to shut it down temporarily. So why does short selling exist at all? If it's risky and controversial, why allow it? 3 reasons. First, price discovery. Short sellers push overvalued prices back toward reality. Without them, prices can only reflect optimism. That creates bubbles. Short sellers are the market skeptics, the ones willing to bet against the crowd when something doesn't add up. Second, hedging. Portfolio managers don't just short stocks to speculate. They short to protect other positions. If you own a basket of tech stocks and want to reduce your exposure to the sector, you can short an index. The short offsets part of your risk. It's insurance, not gambling. Third, liquidity. Market makers regularly sell short, not because they think prices will fall, but because a buyer needs shares right now and the market maker doesn't have inventory. They borrow, sell, and cover later. Without that ability, markets would freeze every time demand exceeded supply. Short selling isn't just speculation. It's infrastructure. Let's bring it together. Short selling reverses the usual sequence. Sell first, buy later. Profit when the price falls. The 5-step cycle is borrow, sell, wait, cover, return. You need a locate to confirm borrowability and margin to collateralize the position. 50% initial, 25% maintenance. Costs include the stock borrow fee and any dividends you owe the lender. And the risk profile is fundamentally asymmetric. Bounded gains but potentially unlimited losses. Markets allow it because short sellers contribute price discovery, hedging, and liquidity. Regulators can restrict it during crises, but they can't ban skepticism itself. Next time, what happens when too many people are short the same stock, and the price starts rising instead of falling? Lesson